And we proceed now directly to our second speaker, who obviously is getting his microphone at the moment. Our second speaker today is Dr. Markus Berndt, who works as Head of Strategy and Policy Division at the European Investment Bank. Besides different positions at the Investment Bank, his economist career includes such institutions as International Monetary Fund and the Federal Ministry for Economic Cooperation and Development in Germany. So I really think we have a right experience and a right background for a man to enlighten us about the role of European Investment Bank and public development institutions in promoting investment-led recovery. Please, Markus, the floor is yours.
Well, thank you very much for that kind introduction. While Antti is looking for the presentation, I might confess that this is the first time I'm in Finland. And when I told my Finnish colleague, she was saying, "Oh, it's too bad you can't come in spring." So I was expecting the worst, but then I was greeted by this warm and sunny, not warm, but sunny day. So that was a very good impression. Stephanie was apologizing for a dry and technical presentation. I hope this is not getting even drier and even more technical. But I'm very pleased to be here, and I'd like to thank the Kalevi Sorsa Foundation and Mika, Mayanda, Antti, and Giovanni for inviting me here. And I think it's good for me and also for the EIB to be present in this, because we can tell you about our perspective as we're directly implicated. We were talking a lot about investments. I just want to start the presentation by saying why do we care about investments? And one thing is, of course, investments are to invest in the future of Europe, of the European citizen, and to make sure that the European Union can stay competitive in the global context. And Stephanie was already referring to it. And if you look at the historic data since the 90s, we're so preoccupied with the crisis. But even if you look at longer-term data, you see that actually the GDP per capita, Europe is a poorer region. We know that. We're coming from Second World War. We're coming from the Iron Curtain and so on. But normally you would expect some kind of convergence to richer countries. But if you look at the real GDP per capita, you see that actually the gap between the EU and the US has widened since the mid-90s. And what is also a bit worrisome is that the crisis had led to a significant downward revision of the estimate of potential growth. Now you can debate, there's a lot of academic debate about how you estimate potential growth, but the fact is that our view now of what is the potential growth of Europe, of the European economy, has had to be revised significantly downward, and there's no clear trend to revise that up yet. So why I left a little paper out there at the entrance, and where we try to think about what is driving competitiveness of Europe. And competitiveness, I guess one of the reasons why we were writing that paper was to clarify that if we talk about competitiveness, we as a promotional bank like the EIB, we're not talking about price competitiveness or misalignment of real exchange rates. We're talking about long-term competitiveness, so productivity growth. And what are the drivers? Well, there's there is three things. Basically, if you want to grow, you have to have the capacity to change. Or companies operating in that economy have to have the capacity to change. They have to innovate new things, and that's particularly important for countries at the innovation frontier like Finland. They have to absorb. That's very important throughout Europe, but of particular importance to the less developed member states, and they have to allocate resources efficiently. And what is driving this is very much this is all very much depending on the enabling environment. So there's institutional markets, but there's also the financial sector that provides the means to invest in these activities. There's the human capital, and there's also infrastructure. So, and if we look at this capacity for change, you see that, well, the best measure of that is the so-called total factor productivity. So how well do you combine all the resources that you have, labor and capital, into productive use? And if you look in the middle of this chart, you see that it hasn't been so good. The growth of this hasn't been so stellar before the crisis in the EU if you compare to others, but it has significantly suffered in the EU to the extent that we now our view of how well we're doing in terms of combining labor and capital is that we has not only not grown, it has even become worse. And you might think, oh, that's all because of the South, but it's true throughout the EU, also in the North and East. That's worrisome. So what can you look at if you try to find explanation for some explanations or hints for why that might be the case? Well, one thing, the easiest thing to look at is, well, how much do you spend on research and development? And the EU is this red line there. And as you can see, we've constantly spent less per GDP than a lot of other comparable economies. China has just caught up. And there are others like South Korea that have significantly increased their thing. And I don't know if you remember, there was at some point a target, an EU target, we should be spending 3% of GDP on research and development activity, and we are far from reaching that. And if you would try to reach this target, which is not completely off, because you see the US is almost at 3%. Japan is above it, Korea is above it. If we were trying to reach this target, we would actually need to invest 130 billion of euros more each year. Now you might think, well, maybe we're so efficient and we don't need to spend that much because our research is so efficient, we're just better. But even though it's hard to compare output, if you look just at the mere patent applications, it doesn't look like EU. I mean, there seems to be a correlation between how much you put into R&D and how much the output is. So there are 30% less patents in the per EU citizen than per US citizen, and of course much more is South Korea or Japan. Now, being in Finland, of course we have to acknowledge that there's a great heterogeneity in terms of R&D investment, and you see Finland is certainly the leader here. Although Finland also has a very ambitious target. It set itself the target of reaching 4%, which it hasn't reached yet. But what is worrisome, well, one thing, the EU, if we see the EU as one economy, it's normal to have certain centers where R&D happens, and because of the network benefits of putting knowledge at one place. So that would be, I don't know the data, but it would probably look similar if you look at US data for different states. But what's a bit worrisome is that especially the leaders here, Sweden and Finland, have significantly reduced their, I don't know if you can see, it's a bit blurry, but on the right-hand side, the blue bar, have significantly reduced their R&D spending as a response, as an effect of the crisis. I was talking about the ability to modernize. We have in this little study, which is also available on the website, we've looked at what would you need in order to reach the standard in terms of IT and other elements in the industrial sector, and we find that actually there's a great need for catch-up. You would need an additional 90 billion for modernization. And I was talking about the reallocation, and that's to some extent linked to the financial markets and also other institutional factors. An interesting research here, it's a bit by Bravo, Bioska, Griolo and Menon, is where they were looking at the share of firms, of fast and slowly growing firms. And if you compare to the US, you see that in Europe we have a much more static firms. We have less firms that grow fast, and we have less firms that shrink. And that may point to some gaps in terms of reallocation of resources to more efficient uses. If you look at the enabling environments, well, well, I won't talk much about the institutions and markets, although there's a lot to say, merely because I'm coming from an institution that doesn't have recommendations on institutions and markets in their mandate. So I will leave that to our colleagues at the Commission and the OECD and others. But if we look at the financial sector, I think it's important to note that the EU has a very bank-based financial system. Of course, that doesn't exactly help if you go through a bank crisis. So that explains, and there's also research that shows that if you have a bank-based system, you have a deeper crisis, and you also have a longer crisis. It's much harder for Europe to recover, but you cannot change your financial system from one day to the other. So even though we have now initiatives like the Capital Market Union and others, it'll take a while. So there's going to be the financial sector is going to be an impediment to growth for some time to be. The other thing is, if you look at the stock market capitalization, which is particularly important for equity financing, is particularly important for innovation activity. If you want to be at the frontier, the most important type of financing that you get is equity type financing. And if you compare the EU with others, for example, the US, you see it's not only half the size, it's also highly fragmented. There's not the one New York stock market. There's Paris, Frankfurt, probably Helsinki too, and others. And that, even though startups and other companies, of course, they don't go right away to the stock market, but a lot of these investors who invest in these types, for them it's very important to have exit opportunities and to bring them, once they've grown that company into a good side, to bring them to market. And for that, it's important to have liquid stock markets. There was actually a question about the Juncker plan only investing in physical infrastructure. Who was that from? Was from Giovanni. Actually, we do also envisage to invest in human capital type of investments. So education and health is part of the sectors that we foresee to be investing in. And we think this is badly needed. If you look at the education expenditure in Europe, you see it's much lower than in, for example, the United States or South Korea. Importantly, you see that most of this gap is explained by the tertiary education, which is worrisome if you want to be at the frontier again. I mean, if you want to be a rich economy, you have to constantly innovate and constantly move on and find new ways of enhancing your productivity. And tertiary education is a very important element there. So there's certainly a gap. We estimate that it's around 100 billion euros of additional investment in education, of which 10 would be in education type infrastructure. That's important for us because we wouldn't be financing, the EIB doesn't finance teacher salaries, but we do finance research labs or other infrastructure that helps education. If we look at the other ones, and I won't bore you with all the details, you also find other shortages in other areas. There's energy, especially if we want to be serious about renewable energy efficiency, but also about security of energy supply, which is of particular importance in the current geopolitical situation. We find a gap of around 100 billion a year for transport. There has been a significant time of underinvestment in the recent years, which has led to a certain backlog where we estimate 50 billion of additional investment needed to reduce congestion costs and trade bottlenecks. I mean, transport. All this we're saying is important to fulfill the European market integration and to have the competition, have the mobility to actually make use of this great European integrated economy that we have. So it's not only that it takes longer to go on vacation, but it takes longer to bring your goods from A to B, and therefore you're less productive in producing what you're producing or want to produce. Of course, very important and increasingly important is the infrastructure in broadband and data centers. We had at some point the so-called EU's digital agenda. We have various objectives there. And if you compare to the actual investments that we undertake yearly, right now there's a gap of around, well, around 50. We calculated 55. So this was done by engineers, so they're very exact. 55 billion a year. And then environmental services. This is, you might think, might be surprising, but one thing is that a lot of this infrastructure has been built after the Second World War, and it's just coming to an end of economic life. So there's a lot of investment needs right now, which are not really matched by actual investments. So why all these numbers? The point here is, I think this is very important. The choice of these investment areas is not random. Right? The choice is, these are goods where these are, well, I guess the classic term is that these are so-called merit goods. Here you have at times some kind of a market failure because the investment in this good does not, the returns that you get from the investment of the good does not all flow back to the investor itself. It has benefits to the society that goes beyond the actual returns of the investment, and this is what's basically motivating the Juncker, this so-called Juncker plan. Or that's where we want to undertake the investments. So it's not, and Stephanie has already said it, so nothing to add. It's not to replace private investments. It's investing in areas where private investments don't happen to the socially optimal degree, just because of the nature of the investment. So if we say broadband, we don't mean broadband in a highly densely populated city center where it's profitable anyway to put a broadband cable, but we mean exactly those areas where the profitability of this investment does not compensate for the overall society benefits of connecting, for example, rural areas to the broadband grid. So we've been talking about, so do we invest a lot in Europe? Or do we should, given these gaps, we should be investing more? If you look at the investments as percentage of GDP, excluding dwellings, so the productive investments, you see that we are structurally investing less than the US, and the gap has widened during the crisis. If you compare, and Stephanie has done something similar already in her presentation, if you compare to the, let's say, what our friends at the Commission called in this, where I stole this graph from, called the sustainable trend of investment, which is, if you exclude booms and busts, if you just look at how much do you invest per GDP, if not in a recession year and not in a boom year, so excluding, for example, the golden days in Spain where everybody was investing in construction, usually investments are around 21 to 22%, and as you can see, in 2013 it was significantly below that. I haven't updated the charts because I stole it, but it's also the case for 2014, as you can see in the blue bar on the right, which we produced ourselves. And I think what's important, actually, the message of the right-hand side is to say that this is not only, because many people think, oh, that's all Greece and Portugal and Spain, it's going all the way down to, in this case, Hungary, where you can say, if you compare to a normal level of investment or some average, historic average, we are below that, even Finland. But this is, of course, a very rough estimate, but we just for transparency, we kept it very simple. I think I don't want to spend too much time on this, but since it was mentioned, the so-called special task force, there was, and I think it's important because whenever you talk about the Juncker plan, that's one of the things that found a lot of media attention, is this task force that was set up between the member states, the Commission, and ourselves, where we were identifying projects. I think it's one thing that is important, and that's why I'm bringing it up, is to understand that this project list, which is on our website, I think you see the link here, is not the pipeline for the Juncker plan, and there are various reasons. The main reason for this was, first of all, to overcome the notion that there aren't any projects that are available for investment, because, yeah, as you can imagine, shifting from one policy stance to another creates a lot of resistance in some member states, and some were saying, oh, but there's nothing to invest. And so this was merely, so for 2 months we were working together with our colleagues in the member states and see what projects there would be to invest. So that is that. But I think personally more important is actually that it also served to identify some impediments to investment. So why don't these investments take place? Well, as an economist, you always think in equilibrium. So if it was worth it, why doesn't it happen? And I think it served very well to address coordination issues among the member states, because it was everybody was working together, thinking about projects, and that, for example, alleviated some of these coordination problems for cross-border investments, where then all of a sudden both member states were sitting at the same table and saying, oh, maybe we should invest it. So if you look at this project list, you see 2,000 projects. They're worth around 1.3 trillion, of which realistically 500 billion could be invested in the coming 3 years, or in the coming 3 years, yes. But this is not exhaustive. It's also not every single project there makes sense. This was done in 2 months, some member states were more creative than others, some more ambitious than others, some were centralized, some were federal states. So all these institutional setup influenced what project made it on there. But most importantly, some of these projects would be perfectly eligible for financing under the existing EIB product line. So we would just finance this project anyway, even if there's no Juncker plan. But there's a lot of projects that don't go on this list because, for example, if you are a high-tech company and you have a very good idea about a research project, something that is, that's revolutionary, and you have a good idea and you want to get some investment, which the EIB would support as well. If we think this is there's an positive economic rate of return of that investment, then this company does not want to get on any list that goes on the website. So these people would approach us, and these are exactly the more risky projects that are coming up. So most of, my guess is that, well, I won't publicly make any guess, but many projects anyway will go under the Juncker plan that are not on this list for very, very understandable reasons. These investors do not want to put this on the list. Okay, I was already talking about this. This is what's on the list. As I said, I just told you not to pay too much attention, so I cannot talk about it. Here, what I want to put is the barriers that prevent these investments from happening. And you can see that financing constraints is the biggest in terms of answers or reasons that were given, but then followed by regulatory framework. So that's where Juncker and also ourselves say, well, this is one part of an investment initiative. Is what's done through the EIB, but there needs to be other things like regulatory reform that on all levels, EU level, member state level, sub-sovereign level, and so on. Okay, so what this plan that we're involved in is trying to address is some of these financing constraints. And when we say financing constraints, and it was already mentioned before, it's what we see in terms of where we think we can provide most value added is in terms of providing more risk-bearing products that are able to absorb certain types of risks. And why is that the case? So what's different now than before the crisis? Well, for one, before we talked about this, we have member states are fiscally constrained. They see the need to consolidate their public debt, and that is not always. So that's not always one-to-one correlated with the current financing costs, because some of these are being based right now in Luxembourg. They know they have to, even though they have hardly any debt and get money for free right now, they know they have a huge pension fund benefits to pay out coming soon. So they do feel some kind of constraint, and they cannot take all this risk on their budget as they've seen. This is just citing some research from the Commission saying that if you were to try to reach 60% of GDP by 2020, how much would your adjustment have to be? The other thing is the banking sector. I was mentioning before, banking sector, the banking sector has obviously gone through a crisis, and there was a regulatory response to that. You can discuss every single detail of it, but on the thrust of it is I guess it was very important to have that regulatory response. But as a result of this, the banking sector is now less risk-bearing capacity. It has to fulfill new requirements in order to do so. And there's a transition period where the banking sector is certainly impaired, which is troublesome if you are an economy that's mainly relying on the banking sector. So what can be done? Let's just check if I'm... well, I mentioned structural reforms. Of course, it's also important to continue the European market integration because that's clearly a driver for further investments. And integration is not only institutionally, but also physically. So then that brings some of this infrastructure that I was mentioned before. We can do more type of project preparation, project coordination on the EU level, which is this task force I mentioned before. We think there's a need, or when I say what can be done, what can be done by a public institution like ourselves, right, or any public institution. We think there's a need to foster financial market development because of the structural breaks that have affected the European market, and we think there's a need for targeting, or there's a particular need now with the other constraints for targeting competitiveness, enhancing investments with the aforementioned positive spillovers like research, development, innovation, skills, or infrastructure. And you have noticed that there were different colors used, and the point being that what we're trying to do in this Juncker plan and the EIB regular business is what I left in blue there, European blue, I guess. Talking about the EIB's regular business, so this, this is just to give you an idea what the EIB has been doing regularly without the Juncker plan, because it existed before. I think what's important here is that roundabout, and you can discuss this in the single number, the sustainable level of investment that we can undertake in Europe without straining our balance sheet would be around 50 billion euros. That's the blue part. Now, at the beginning of the crisis, we were significantly responding to the needs, especially in the financial sector, trying to, or I think we can say that we kept some banks from collapsing, especially in Eastern Europe and so on. So you see the first surge there of EIB signatures. And this was possible without any capital increase or anything. It was just because there was a certain buffer built in the balance sheet. Now in 2012, that buffer was completely used up, or almost used up. Or by the end of 2012, it was used up. So you see this going down. And this was, of course, not a very helpful response to a crisis, because I mean you would expect, just like we did in 2008, 9, 10, to have an anti-cyclical response of a development or a promotional bank or a development bank or whatever you want to call it. So that's exactly why we then, thanks to Stephanie and other policymakers, successfully asked for a capital increase in order to be able to engage on a second anti-cyclical response. And so now we're in the middle of this. Actually, we are closer to the end because our colleagues in 2014 were very ambitious, and we managed to actually over-deliver. So if you get a capital increase, basically what happens, you have the capacity to increase your balance sheet. You can lend out more until you reach the next limit, right? And we were thinking that we could do around 20 a year in 3 years. But as you can see, we already did a bit more in 2013, 2014. That's why we will reach that limit already much earlier this year than anticipated. So So that's the capital support activity. Just about what are we doing in general. This is the breakdown. There's a lot of support of smaller enterprises. Not all member states have an institution like the KfW, so there's a need for supporting that kind of business in other member states. There is investment in infrastructure. There's a lot of activity in the field of climate action because we're supporting EU policies, and there is also a sometimes forgotten significant portion of supporting innovation and skill type of investments. So now, what's new? What's going forward? So we've already discussed this, but just to have a chart here, what this Juncker plan is. The heart of this is this so-called European Fund for Strategic Investments. That was has a very bulky name, but okay. I guess there were only technocrats involved and no communication specialists. It's also grossly confusing because it's like EFSF, ESM, EIF, EIB, but anyway, so it's another E acronym. So there was the question actually, is there any new fresh money, right? So I can maybe use this chart to explain why there's some fresh money or why we are, where the fresh money is coming from. The easiest part is probably the EIB part. So at the time of the capital increase, we were less optimistic about the crisis and the impact that the crisis has on our assets. So during the last 2.5 years, we have actually used less capital than we thought for the activity that we've done, which gave us a certain, which built up another kind of buffer in our balance sheet. And it's the decision of our member states to now use up this buffer, not to have another buffer like we had before the financial crisis, which is also useful to have a buffer, right? Because the buffer allows you for a counter-cyclical response. But the decision of our member states, which are the shareholders of the EIB, was to say, no, we don't want to have a buffer. We want to use up this buffer. And that's the fresh 5 billion. Otherwise, these 5 billion would have been used to build up a buffer. So that's fresh, has never been planned to be used. So that's one fresh element. The other one is fresh, is the EU guarantee. Now, this guarantee is in principle functioning like equity because we get. First I have to say all of this is just the plan. This is currently being discussed in the EU among the EU co-legislators. So there has been a proposal of the Commission, just to be very clear, there has been a proposal of the Commission. This proposal has been, a view has been developed by the Council, which is representing all the member states. And right now the European Parliament is developing their own view. And then we hope that by the summer, in the so-called trilogue where the Commission, the Parliament and the Council are then coming together and finding a compromise that sometime in the summer there can be a final vote that makes this happen. So far none of this. Oh, well, I come to that later. A bit of this is already happening, but none of this doesn't exist yet. This is currently this is a proposal, but from what, well, it looks like it with the strong support of Mr. Juncker and others in Brussels, it looks like it's going to happen. Anyway, so because the other part of this, and that's why the Parliament is, of course, having the most difficult time in these negotiations, the other part of this is the 16 billion guarantee. This guarantee is coming to the EIB as fresh money. So we from day one, if this is in place, we have a 16 billion guarantee on the EU budget. And that means we can easily go to the market saying, look, we have these 16 billion, please fund them. And then for us, it functions like equity. So 16 plus 5 is 21 billion. That is more than twice the last capital increase. So this is a significant increase, and this is fresh money. Now, that being said, the 16 billion guarantee, the European Parliament and the budget, they will have to make some kind of a provisioning. So they, it's likely that we call some of this guarantee. A guarantee is there because we will take risk and there will be something. So what the Parliament wants to do and the Commission wants to do is they want to set some money aside. Right? They don't have to set aside 16 billion because it's not likely that we'll call 16 billion, especially not on day one, because we won't even have business of 16 billion. But there will be calls, and for that you put aside this so-called provisioning, and this is the money that you have to, in principle, deduct. Right? So it's 21 minus whatever you want to provision. But we would say that this money is well spent because instead of providing just this amount of a subsidy, this is being used to finance this, which is then financing loans. And in principle, the money is not in principle. Some of this money will also come back because the guarantee at some point, if this is over, then the guarantee doesn't have to guarantee anything anymore. So with this 21, which is fresh money for us, we envisage to finance two different types of activities. One is dedicated exclusively to smaller and medium-sized enterprises. And then there's another one that's going to concentrate mainly on infrastructure, but also on infrastructure and innovation type projects. Sorry. And another question is, what is this multiplier of 15? That has been questions. Well, first of all, these 60 and 5, but that's a technical detail. It's probably only interesting for us. One will be deployed through our subsidiary, which is concentrating on SME products, and then the other one is going to be deployed through the main EIB body. And these 15%, and maybe these 15, I can skip to this. Why do we come to these 15? If we look at our standard business, our standard operations before Juncker, right? There's always this multiplier always happens at two levels. First of all, we get the public money, and with this equity, we can go to the financial markets and sell EIB bonds. So, and in our relatively less risky business, the EIB, which I call EIB standard here, and by the way, this is only conceptual. This is to make it, to explain. For each euro that we get from public money, we can borrow 5 euros on the market, because the market knows, okay, we have this equity. So then we have 6 euros, and then with these 6 euros, we support investments, and on average, actually, this is just to make it 15, but on average, we only have to finance under this window about 1/3 of the project for the project to happen. So the 2/3 will then come from other investors in the project. And this is what's leading, in this case, to 15. Actually, in the case of our capital increase, Stephanie has given some number. The current estimate that we have is that we are reaching around 18. So I think you were giving 16, but the capital increase finance projects have a final multiplier. So it's the internal leverage that we get by selling EIB bonds plus the external one by catalyzing other investors would be 18. Now, what's new in the Juncker plan is actually that we will increase our focus on so-called more risk-bearing products. That is not to say that we haven't done this before, because we already have very, very risky business, but we don't have right now, without this guarantee, we don't have the capacity to do much more of this because of capital constraints. And the nature of this is that for every euro that you lend, you need to have more capital. So the internal leverage is less. That's why here, we only envisage to finance around 60 billion with the 21 billion of equity. So we only have a leverage of 3, not 6. Because if you have riskier products, then capital markets will only buy EIB bonds if you have a lot of equity on the side, because they know a lot of this will be lost. But on the other hand, if you have this riskier project, so if you take, for example, an equity stake in some kind of investment, you only need to have a very small portion to make a whole project happening. And that's why the external effect is greater. So in this is just the conceptually, so if you have some what we call special activities, it would be ×5. If you really put equity, so you take €1 and you put, this is so risky, you're taking the actual equity risk of a project, then you only take 1/15 of the, on average, of that project. And these 15, which I just made to be 15 here for conceptual reasons, is actually, we are very, if we look at what we've done in the past, and we've done all these kind of activities, we feel very comfortable with 15 because the range is 15 and up, right? So we've set this is a political, you wanted to settle on something, so we settled on 15, and now the only problem is that with 21, if you take 21 times 15, it sounds very precise because 21 times 15 happens to be 315, which gives the impression that you know exactly what the investment is. But all we're saying is 350, we're very comfortable that it will be 315 because of 15 times 21. But I mean, it may be 320 or 340, or so it's a pseudo precise number. And anyway, it's because we are very, very confident that 15 is not over ambitious. How am I doing on time? Oh, I'm running close to the end of time. Well, I think I've said this. This is only one part of the investment plan. Is this so-called EFSI? There's many other elements, like the idea to have a more concerted effort in terms of project generation, like an increased what we call an advisory hub that helps generate products that help where we advise our member states on how you actually get projects done from a pure administrative point of view. We talked about this. We talked about this. We talked about the product mix. Very good. I don't have to go through this. I think one thing is important. So people were saying, well, wait a minute. You're still financing bridges. Or this is supposed to be a beautiful European bridge. And now you're telling us you help member states not to take the risk, and how does it work? But at the same time, how does that work? And if you then compare the classical way to finance a bridge, is the member state takes a loan and then sells bonds, Finnish bonds. The private investor makes an investment, buys some Finnish bonds, and then but they actually buy these bonds not because they think the bridge is so reliable. They buy it because they can rely on the state whose bonds they're buying, and then the state is investing in the bridge. The bridge generates some returns in terms of growth or whatever, or if it's a toll, ideally, in a simple example, would be a toll bridge. You have to pay something for it, and then the state is paying some of that back to the investor, and the rest is to the benefit of the state. Now, how this is working, first of all, it's not the member state. Now, the risk is going to be taken, or the risk bearer is the EIB, or with the help of the EU guarantee behind. Now, the investment in the bridge would be a special purpose vehicle. Sounds very technical. It's like a private partnership, kind of. You invest directly in a company that builds the bridge and then owns the bridge and then gets the toll. But that itself is maybe not is too dangerous for the risk for the investor. So they want some kind of assurance that this is not this might be too risky. So that's what we provide. We provide in the extreme case, we would provide just a guarantee, some sort of guarantee. Or we take an equity stake to make the remaining portion of the bridge less risky. And then the bridge is generating these returns, and some of them go directly back to the private investor. And then the remaining returns go to Europe, and so the point is that this is not the second option, which is kind of the typical Juncker planned finance project. Is generating the same investment, but it also generates the same risk. The risk is not going away. There's still a risk of this. Nobody likes the bridge, or it breaks. There's an earthquake or something. But this risk is not borne by the member state. It's borne by on an EU level, and that's the difference. Since I'm running out of time and I'm anyway not comfortable commenting on other people's work, I'm just giving you what is the estimate. The EC has made some estimates. The ILO has made some estimates. We are currently looking at our own estimates, and that's why I don't want to comment the colleagues' work yet. The point is just and that's my last slide. Don't worry. The point is that if you compare, because I mean, many people say, well, this doesn't make any difference, right? This is so small. And you can debate that, right? But I think it's just important to say that this is concentrating on a certain subset of investments. This initiative is to address merit goods or market failures in the widest sense. And if you look at this, if it's supporting 105 billion of investment, then you would say, oh, it's only 0.8% of EU GDP. So this, this is a drop in the water. It's 4% of investment, but what we want to say, what's important is it's almost 12% of the investment in these target areas that we're looking at. So that's research and development. It's the technology adoption of, let's say, SMEs who have financing constraints, and that's why they cannot adopt the latest technology and so on. And so when we try to look up our own estimate, we got to look at the internal leverage, external leverage. I explained. I think it's very important to look at the additionality. Not in terms of where the funding comes from, I explained that, but the additionality of every single project, right? You have to make sure, and we have a system that tries to ensure for every single project that we're not crowding out somebody. We're investing in something that otherwise wouldn't happen without an investor like us. Of course, there could be KfW, could be doing a similar thing, but then this has a direct effect. People working while they're building that bridge. There's an indirect people who suppliers, but it also has an induced general economic effect, and these are their macroeconomic interlinkages between economies. But one thing that's why we are that is very important is given that this is not only for investment per se. It's not the main reason why we support the investment in, let's say, the bridge is not that the investment of the bridge is good itself. As Stephanie said, it's good for demand, macroeconomic demand, and that might be a good reason, especially now. But the main reason is that by connecting A and B, the productivity of A and B is enhanced, and of the EU as a whole is enhanced, and that is increasing the potential growth that, unfortunately, has been revised significantly during the crisis. And that's it. I hope it wasn't too technical and too dry. Thanks.
Thank you, Markus. I really started to think that how would I get to my own private economy this multiplier of 15? That would sound very nice. But I'm sure you all got encouragements to make questions, but I think we proceed in such a way that we have now 15-minute coffee break when we start by giving the floor to our two commentators and start panel debate and take questions from the audience as well. So I think it's good position to have a 15 minutes of coffee and a bit refreshments for the debate.